Joining us to provide their expert insight into the tightening crypto regulatory landscape, Ryan Nixon of Horizons Law and Consulting, who has represented some of the most prominent names in crypto, from Solana to Synthetics. Joined by Simon Revelis of Revelis Wayhab, who has launched over 1,000 funds since 2011, is one of the earliest crypto fund lawyers and specializes in corporate and securities law for nearly 25 years. Welcome to the stage.
This is going to be a fun one. You know, the last year has been challenging, to say the least, for the crypto market. We've not only had one of the worst bear market in terms of drawdown that Bitcoin has experienced in the last few years, in the last 11 years. Then we saw one of the biggest frauds in not just crypto history, but financial history, when SBF stole something to the tune of $11 billion from all kinds of users, unfortunately including us as well, which we'll talk about later with Mark. And then, of course, after a string of inaction, when they failed to prevent Terra Luna, FTX, and so forth, we've gone down this rabbit hole now of over 55 enforcement actions.
And so since both of you represent two different angles,
one the fund side and one the token side, more or less, what are like the top three issues that you kind of deal with right now? Like what's been crossing your desk? Of course, don't name the clients, you know that as well. But what are the common causes where the SEC or DOJ, I mean, all the letters are currently coming up, are fighting back against crypto?
Yeah, sure. So I'd say from the token side, the first major issue is structuring, like legal structuring, entity structuring, formation. I think last cycle, ICO craze, was a little bit of a different structure that we see now. Frankly, with everything that has been going wrong, so we have Horizons Law, which is a domestic entity, and then we launched Horizons Global, which is a Cayman fiduciary, because all of these token projects, if they're onshore, there's a DevCo, right, which is just mostly used as their fiat on and off ramp, and then they'll either be set up in the Cayman Islands or Switzerland, and I think we've also seen kind of incoming Dubai as another sort of jurisdiction that's friendly towards crypto. So the first issue is just really where can they get set up so they can raise. Second is banking. Right, that has been a major pain. The whole point of like the DevCo, like onshore, some offshore foundation structure is so that like these founders can have banking rails, so they can pay gusto, so they can pay benefits, so they can pay people that don't know what a multi-sig is and how to receive crypto, and that's been a real issue. So I think it's been those two, and then just frankly, token launch, how to get distribution out. Where does token mint occur? Token mint right now, at least for our clients, we advise it's all offshore through, a foundation that is ownerless, that has their own like director, that has a fiduciary towards that foundation. But that said, there's like no right answers. And I think what's been the biggest issue is, and then I'll let you jump in, Simon, is I think lawyers, right? You guys pay us to interpret the law and to tell projects, hey, this is how you do a certain thing. And I think in this regulatory environment, much like Felix showed, right? You have Gensler, shaking, saying one thing, then saying another. I mean, we're left stuck trying to interpret whatever the next move is, and still come to projects and say like, hey, this is okay. So.
Yeah. So from my perspective, focused on funds, certainly. A lot of managers want to hedge risk through derivatives, and the CFTC, the SEC, has been cracking down on access to derivatives for U.S. managers, which, frankly, if they continue on the path, is really going to, cripple the U.S. crypto funds market, at least the private markets. For registered investment advisors, the custody rule is going to be very restrictive because, a limited number of qualified custodians who they can counterparty with. So those are two major issues that my clients have been dealing with. The spiking costs in audit, the difficulty in finding a banking custodian, those are some more issues.
Yeah, I remember when we first launched the fund, the audit price from launch to now has gone up to the tune of 7x in the span of 5 years. And so, any new fund launching now would be unable to even pay that. You mentioned the custody rule. I think that's one of the biggest topics right now, because to put it in layman's terms, any normal equity fund would need to trade on a qualified custodian. The problem is the rule said, as he said in the video, have you passed any new laws? And he said, no, we're using the old laws. Well, they don't quite work with crypto because they're a little different. And so I'll give it over to you. Where's the line? Do you think funds will fight back and the custodian rule will not go through, or will the U.S. market just be hamstringed?
Sure. So, I mean, personally, I think the qualified custodian rule has a lot of really fatal flaws. First of all, qualified custodians, I think that there's a lot of just speculation. So this is just my speculation, but the SEC isn't a rule-making body, right? The SEC cannot make law. Congress does, right? But what they can do is they can do these sorts of actions like the qualified custodian rule, which would limit who could be the custodians to these centralized players in the US. What kind of problems does that have? Well, that wouldn't be Binance, especially with all the CFTC and like legal issues they have right now, except Binance is 100 times more liquid than some of these other centralized players in the US, like a Coinbase or Kraken. Binance also has perps. So to Felix's earlier point, how would any fund manager be able to hedge their risk, plugging into Binance when it isn't a qualified custodian? They'd be violating the law. Right? There's lots of other, in my opinion, just fundamental flaws with it from a technological perspective. For example, under the qualified custodian rules, MPCs, I don't know if anybody is aware of like Fireblocks, or like there's these sort of permissioned wallets that are coming up now that we could settle these different sets of permissions. MPCs would not exist, which is going to really mess with the security in this space. And frankly, I mean, again, not to do another shout out for some of the work we've done, but we've spent a bunch of time to set up a private key sharding custody sort of activity for my firm. We provide private key card sharding for CoinList, Uphold, Copper. Like that also wouldn't work. So by pushing through this rule, it actually would be weakening security across these protocols. I think it's terrible.
No, I think certainly there's going to be a smaller set of managers under 150 million who can avoid technically these custody rules. So I think it'll create this still arguably vibrant smaller funds market, whereas larger funds who have to register as investment advisors are going to be hamstrung as to the types of assets they can trade and invest in, and I think it'll perhaps this is what the goal is to keep the crypto market quite small in the U.S. and not create a robust regulated market.
Since the SEC has been unable to provide regulatory clarity through the words, there's three major cases that could bring us some clarity, which is one, the Coinbase case, where Coinbase is now suing the SEC counter, which could bring clarity for exchanges since they brought action against Bittrex, Kraken, and a host of other exchanges. Another one is DCG, where the SEC has been not allowing them to launch an ETF, where for years and years and years we're trying to get an ETF, but now Grayscale's asset trading at 50% below book value, punishing investors, not protecting them. And then the third one is the Ripple case, where the SEC claims their security token. On any of those three, because all three of those could have a major regulatory unlock, providing clarity for exchanges, providing clarity for tokens, and getting us an ETF. Feel free to comment on either of them, where you think, where could those cases go? And, what are some takeaways from you so far?
So I'd say probably from the token company side, I mean, obviously Ripple would have the longest and most relevant sort of effects, and whatever precedent came out of that, I think could be either very damaging or very helpful and hopefully clarifying. I mean, actually, let me amend that, because even if Ripple came out and said, Ripple is a security for XYZ123, at least as attorneys, we could rely on that precedent. We'd say, hey, you guys are likely to be a security at this point in your distribution of your token, because look what happened in Ripple, and XYZ is also XYZ on this side, right? So matched. Great. Now we could advise on how to make it less like a security. I think the just blatant lack, and to what you had with Gensler, this sort of Hotel California, check in and can't check out, is really problematic. It puts a lot of fear and trepidation into the space. But yeah, Simon.
No, for sure. Yeah, it's sad on the one hand that the regulators in this securities and investment space can't really get their acts together, and it has to it's left up to the courts, which is a random and haphazard way to make regulations. Yes, so I think it's very difficult to handicap what the outcome will be on any one of those cases. But I suppose the SEC would have to live with whatever outcome there is on any particular matter.
I know, Ryan, you mentioned you launched Horizons Global, and I've spoken with both of you about us potentially going offshore. This offshoring has become a bigger and bigger conversation. How have you seen it among your client base? Maybe what percentage of domestic funds are exploring that idea of saying, you know what, the US is unworkable, let's go somewhere else? And also then, what jurisdiction have you seen the most?
No, I think certainly lately, as the SEC has been tightening the noose, or this issue has come up more and more. And certainly for U.S.-based crypto managers, Puerto Rico is a jurisdiction for tax reasons that is very beneficial. From a regulatory perspective, the difficulty for U.S.-based managers is, to the extent that they have U.S. investors, it's very difficult to extricate themselves from the web of U.S. regulation. So they would have to both move outside the U.S. and give up their U.S. investors, which is difficult to say the least. There's no easy answers, frankly.
Yeah, I think Simon's probably a little more expert in this than myself, but I would say I agree with everything he said. Would you want me to speak on the token side a bit? So on the token side, where having a foundation would be an important thing to have, and maybe at a certain point in time we could do it. Now it's literally second step, and it's only second step because projects have to raise to even afford this offshore structuring, right? And also, to be clear, this Horizons Global is a small piece of that fee take versus the offshore firms. You need a secretary, not just a director. You need a registered office. Like, there's all of this stuff. So now sort of the game plan is, if you come and you're this wicked smart kid from blockchain at Berkeley and you want to raise, is first we have the conversation, hey, you should probably do a US DevCo for these reasons. They're probably scared about even doing that, but then it's like practicality takes place, and it's like, hey, how are you gonna have a bank? Like, how are you gonna pay your US people? Like, you have to sort of take this risk, and it's crypto. Like, you shouldn't be in crypto if you're not ready for a little bit of risk. What a terrible thing to say to these projects trying to raise on US soil. Right? So what we do is we do a Delaware C, safe and token warrant. Then we use that raise capital and we spin up an offshore foundation. Then it's usually Cayman or Switzerland. And again, we've seen a little more murmurings around Dubai. And there's also like Marshall Islands, which is interesting. I just think that they don't have, as a sovereign, they're not as strong as some of these other, more customary, familiar jurisdictions. A lot of funds that are spun up overseas, they're set up in Cayman or BVI, right? So they'll raise, we'll use some of that raise capital, like $150,000, that's a number, to set up their Cayman BVI structure with directors and supervisors for both, registered officers for both. And the whole process now has this sort of foundation, reg arb, basically, to get them offshore and still protect them at the same time, because they may have U.S. investors, they may have all non-U.S. investors be U.S. founders. There's all of these questions. It doesn't make development easy. It doesn't make some of these young founders, some of them are under 21, right? Build some of this life-changing and really awesome emerging technology. So,
but does it even fully protect them, or is there still a nexus? Because it's hard nowadays to not walk 5 feet in crypto without bumping into somebody that's dealing with a 3-letter agency. And I've had friends, they told me, like fund manager friends that said, almost a week doesn't pass where even they get a subpoena for the companies they VC invested in, where it's not even just the founders. Now it's the founders, it's the VCs, maybe the employees, and that can even be with a foundation. So how well do those governing bodies respect, so to say, these structures? So they just say, hey, we call bullshit, you're the founder.
Sure, yeah. So, I mean, I think there's, after SBF, I think a lot of info requests came out. Like I had a lot of clients, like we're doing very vanilla stuff, then they just had questions like, what are you guys doing? And I think that's sort of to be expected considering how bad that fraud and the damage that it enacted on the space. That said, how you are structured, it's very tricky, right? Do you have open source IP? Have you committed it to your offshore structure? You can't commit your IP to Cayman because of virtual as a service provider regime, right? So any sort of valuable or IP that has an economic interest running to it, then you have to be strongly regulated. So what do they do now? They park their IP in Panama. Panama's not a part of FATF, right? It's not blacklisted, but it doesn't have the best looks. So we park it in there. They'll have their other stuff in the Cayman. Really, so long story short, I think it helps as long as your structuring is very tight, but that said, it does not protect you from an info request. It does not protect you from getting looked at. Have these info requests like turn into an enforcement action? I'm confident and happy to say that it hasn't happened, and I don't think it will. But again, that could change in a month.
What would you say is like the minimum budget that a founder has to expect to launch with just for regulatory aspects and structuring?
50. Maybe $400,000.
Jesus, yeah.
Yeah, and if you think of like a seed,
there's a seed round.
Yeah, exactly. You look at a seed stage raise; they're raising $750K. So how do we handle that? It's like, okay, first raise here, let's do your offshore structure. Second raise, then we'll look at some opinion work, how to move stuff offshore. Are there sort of other things you can do to go towards sufficient decentralization, whatever that is? They won't tell us, right? They won't give us any clue. So we have to sort of infer and go through these weeds and really thread the needle. It's just such a tricky process with a lot of, almost certainty and strong feeling in our advisement, but that's not the way we should practice the law. That's crazy.
And in terms of launching a token, so the standard now, because we've gone from ICOs, there was STOs at some point, but nobody really pursued them that much. IEOs, DAOs, right? So you mentioned earlier that the path now is safe and token warrant.
Yep.
And at what point is it safe? Because actually we have several founders in the room that actually have token warrants. We have token warrants even with the Metaverse Fund. At what point is it safe to convert those? Because I guess that's the moment you put yourself on the radar.
I think the answer is it depends, right? It depends on your risk tolerance, what you really think. Is that really going to subject you to strong scrutiny? You could get, again, an info request. You could have to deal with the SEC. But, is waiting until the tokens are distributed, proper governance is set up, 15 proposals went, everybody else has sold something. It's really this. It's like a chicken and egg problem, right? It's like, okay, you invested, you want them to do well, but also you have a business to run. You have to protect your LPs, bring back a win, right? And this project releases its token, you decide, well, I'm going to wait, because I don't think that they're sufficiently decentralized. Again, what does that mean, right? Just to be clear, I think a lot of lawyers will say we don't know what that means. I do think that when a project has given over most of the control, including upgrade authority, that there's very strong arguments there. The core founding team doesn't control the smart contract or the group of smart contracts which upgrade the protocol. I think that's very strong. I'm not going on record to say that's sufficiently decentralized, but if I was called into court to argue that, I'd say, hey, this project, literally the founders have no more control. So, if that's not sufficiently decentralized, what is? Do we have to shoot them? Is that what Gensler wants? It's being provocative, but
yeah, no, I feel it. Yeah, so Simon, I think you also set up STOs, right? I think, or even STO funds.
On occasion, yeah.
On occasion, how's that market been developing?
It's slow.
Slow.
Yeah.
And in crypto funds overall, because early in my starting presentation, I talked about how AZXZ, for example, used first round pitch books, first round raises to determine the state of a market. you have a great insight into like, the volume of crypto funds being set up. How are those numbers fluctuating over time? Are people still launching crypto funds, or is there currently like a dry period? I know you also do equity funds and everything else.
There's definitely it comes in waves, and typically it aligns with the market. The same wave that pushes the prices up, encourages people to launch, and because they feel like there's going to be LPs there to help them launch. So there's certainly been a significant pullback, but I think the fact that these conferences are going on is a testament that we think the market's long term, and there'll be other waves.
Ryan, one more for you regarding DAOs. I think we previously talked about this on the podcast back in the day, but if somebody wants to start a decentralized autonomous organization, they're not trying to start their own startup, they're not trying to start their own company, they want to start a proper a DAO. What is like the safe way to even do that without 5 years later getting a subpoena?
So yeah, as context too, I think it's important for everyone to know, we still work with SNX, we're still DAO counsel for SNX, Quenta, Aura Finance, a lot of other projects, and maybe a year and a half ago, Kane from SNX, Kane Warwick was very gung-ho on this sort of DAO first, no centralized entity, no nothing, it's DAO, it lives, it's not in the meat space, it's all digital, right? We were one of the biggest proponents of that because, it made sense from a lot of like perspectives. That said, after the OkiDAO action, we've really had to like pivot on some of that advisement. So I give that context just to say that I've been in this side of advising, projects, the DAO side for quite some bit, and have, taken some provocative stances, which later we had to like remedy based on, US regulatory action. To start a DAO, I always tell projects you could start a DAO. Also, one other thing, for a lot of these founders, if you're not a DAO tooling project or like trying to do some interesting new play with governance, DAOs and governance are very freeing. They go towards decentralization, but it's also this thing that founders don't want to spend a ton of mind share on, especially early on. They want to build their cool, liquid staking derivative, cross-chain, with vaults built in. Awesome, right? That's what they want to do. So I always tell founders, you could start it in a Discord, getting a group together, showing meaningful turnover of decision-making to people in your community is like, you have to take that step. You have to get comfortable with it. Because the other thing we also have to grapple with are the founders that are like, yeah, like decentralized, but like, I'm on the foundation, right? It's like, okay, well, sure, but then stop asking me like how scared you are about like regulatory enforcement actions, right? It's hard when you have this protocol that's your baby, and it's like, okay, I'm going to give this over to the community, like it's going to be safe. It doesn't have to happen in a month, right? But I do think over time, if in fact you were ever looked at, I would want all my projects to say, look, we're on a path to decentralization. Here's where we're at now. Boom, boom, boom. We've set up some sort of committee that can handle some of these decisions that's on a term, right? We're working on transparency. That's the other thing too, and I saw this in Jonas's slide. Transparency though, I think there could be a lot more time and energy dedicated to this. For our projects where we can show new metrics, where we can show like complete transparency with founders, with their token allocations, with voting propositions, et cetera, the more the better. Because if you think about the Securities Act, that's the whole point, right? Is to protect people from asymmetric information. So if you are cutting at that at a high level, cut out asymmetric information. So insiders know as much as outsiders. Like, I think you have a very strong argument that you could survive any sort of like enforcement action.
As a final question, you guys are both straight shooters, ethical guys. At the same time, you want to help your clients. What would be some smart regulatory ideas where you say, this would make the life of our clients easier, but still keep the bad guys from doing bad things?
Yeah. What's an example? Yeah. Simon, go ahead.
Smart regulation that doesn't disadvantage.
It protects investors, but it also doesn't kill the industry, in simplest terms.
Yeah, no, I'm going to hand it back to Ryan.
So
Pulling a Gensler on me here.
So I'd say this: if you want to look at like an interesting stablecoin bill, Toomey, right? Rep Toomey, he just retired. His stablecoin bill was interesting. Allowed for privacy, right? Allowed for a lot of things. I think that would be something interesting to look at. I think as far as other smart regulatory arb, so this was again going back to the transparency piece. My team looked at like the SEC's like executive committee on transparent best practices or guidelines, some big, 80-page thing we reviewed because we were trying to go deep on how to increase transparency and how to increase, these projects really don't like, they want to show everybody everything. If that's what like can keep them safe, like transparency is a big concept in crypto. Like that's what they want. So I think if, maybe not Gensler, maybe it's the next administration, their chair could say, hey, look, in post-wake of SBF, FTX, transparency has, again, proof of reserves, whatever you can do and whatever you can come up with that would make things more transparent, the less likely we are to ever have a problem with you. Like, that would be great. And that would encourage safety and innovation. I mean, builders would jump right on that. Simon, I don't know if you have any.
Yeah, certainly proof of reserves would be very helpful, yeah.
Yeah, proof of reserves for exchanges. I think maybe disclosures that scale with the size of a project. I think a $10 million FTV project doesn't have the same resource that a $1 billion project has. I got a lot of ideas, but not my turn.
No, I fully agree with that. We've even looked at, it was interesting for Solana. There was either we're going to do this Reg D route, Reg D, Reg S, or we're going to do Reg A plus. Like that was in vogue. Remember Stacks, Reg A plus? That was going to solve everything. But what Reg A plus did, like on the legal and dealing with the SEC, is as soon as you make that submission for Reg A plus, there's this testing the waters stage, which would put each project in this fucking moat. Sorry to curse, but like they would be stuck there for a very long time. Thankfully, Solana didn't do the Reg A plus route, and I think we all saw what happened next. But that said, I do think we've looked at that Reg A plus model as far as disclosures and being transparent. And if we could, like we've even recommended for some bigger projects to copy some of these things. I think if we got some encouragement from the government, we would see a ton more of that. Because these projects, the real projects are trying to hide anything, right? The non-rugs. But, the rugs are. So that's it.
Amazing. Well, thank you to both of you. Simon was the man that, first picked up the call when as a 23-year-old, I Googled how to start a hedge fund and I found, 3 different lawyers that set up crypto funds. He was one of them and he's been working with me for 5 years now. And so thank you a lot, for supporting all along this journey. And, Ryan has been a great friend as well and, helping, navigate this recent change in landscape. So thank you so much both for coming here and sharing your insights. And let's give a round of applause.
Thank you, guys.